It gives me extraordinary pleasure, and words perhaps cannot capture how excited I am to have Mr. Howard Marks on ET now. I'm going to keep the introduction very simple, which is that he is more than a teacher and a mentor to everyone in the investing world. His memos, essentially based on his experience, really tell us what is right, what is wrong, what we should expect, and what we should not expect. Mr. Marks, what a delight to have you on ET now. Thank you for joining us.
Thank you, Nikunj. Great to see you again.
Mr. Marks, I was going through your last memo, and the Harvard Marks in this latest memo was slightly different. You're talking about growth investing, which is a big departure from the Harvard Marks I know and the world knows, because Harvard Marks is a value investor. Why is that?
Well, my son and his family came to live with us for most of the pandemic, and he is a growth investor, although he's flexible and he's not too dogmatic. But he's been working on me to see the light and to also not be dogmatic. And his position, which I think is reasonable, is that the division between growth and investing is artificial and counterproductive. And that the most important thing for an investor is to be open-minded. And he argues, for example, that the mere fact that a company is run very well, has a great market, and is fast growing should not bar it from investment. And we shouldn't say we only invest in slow growing prosaic companies. The argument is that the mere fact that a company is excellent and thus sells at a high valuation multiple should not bar it. And that we should be open to all kinds of companies, and that fast growing companies can be attractive, and even though they sell at high absolute valuation multiples, they're not necessarily overvalued because of their high quality and great potential. And that makes sense to me. And so I've tried to reflect a more open approach to investing as he urges.
Mr. Marks, historical measure which investors use is PE. And you've gone on record after a memo and have said that expensive PE does not make it a bad investment. Cheap PE does not make it a good investment. Would you
I would change that a little bit, Nikunj. I would say that a low number doesn't necessarily mean it's cheap. And a high number doesn't necessarily mean it's expensive. It may be high relative to history, but not be expensive. It may be warranted, and and if the stock is selling at a low PE ratio or a low price to book, there may be a reason. It may be a poor company. So the point is, we shouldn't buy things just because the valuation numbers are low in the absolute, and we should not refrain from buying things just because the valuation multiples are high in the absolute.
Mr. Marks, in your books and memos, you've always placed extra importance on the behavior of the market.
Yes.
So what, to your mind, captures the current behavior? Is it FOMO? Is it bubble? Is it euphoria?
Well, look, it's certainly reflecting elements of those things. And there is what I would normally call risky behavior taking place in certain ways. The ease of offering SPACs, the ease of doing IPOs, the fact that IPOs double on the first day, the fact that we have what I call FOMO, fear of missing out, and the fear of missing out has taken over from the fear of losing money, because people have to be invested in this world when things are going up. All of these things are somewhat worrisome. And, of course, the PE ratio on the S&P, for example, is high relative to history. But on the other hand, we have to look at the fact that the composition of the S&P has changed. 30% of the S&P is now high tech and software companies, which are much better companies with much greater potential than some of the companies of the past. And so the fact that they carry high PEs and have pulled up the average PE on the S&P may be warranted. So again, I think the mere fact that the PE is higher than it used to be, it doesn't mean that it's dangerous, but we should be alert. In particular, the Fed cut the interest rate to zero. And the truth is that the lower the interest rate, the higher the valuation should be, because obviously when the valuation is higher, the prospective return is lower, which is alarming. But then we say, well, if interest rates are low, low prospective returns are on order. So they're not that frightening. So what I would say is we have to be cautious, but we should not be scared. And there's a difference. And we should not refuse to invest merely because there are elements of riskiness present.
One Howard Mark quotation, which in a sense is etched on my wall, is what smart guys do in the beginning, fools do in the end.
Right.
So what do you think currently smart people should do, and what do you think fools are doing? Because dealing with this kind of a market, Mr. Marks, is very daunting. Everybody's waiting for correction, it's not coming. And
Right.
those who are waiting are not making money.
Right. Well, you know, one of the smartest things I ever learned was back in the early 70s. And a wise investor said to me that there are 3 stages to the bull market. The first stage, when only a very few foresighted people begin to believe there could be improvement. The second stage, when everybody knows things are getting better. And the third stage, when people believe things can only get better forever. And, you know, it's important to know which stage you're in. And the wise man acts in the first stage and gets great bargains because there's no optimism embodied in prices. And the fool overpays in the third stage because there's no pessimism and excessive optimism. So where are we? Well, we're certainly not in the first stage. We're probably not in the second stage. We have to worry about being in the third stage. And that's why I think it's important to be cautious. But at the same time, we're in the beginning of an economic recovery. We had the worst quarter in history in the second quarter of last year. It probably washed out a lot of excesses from the economy. There's no reason to think we're going to have another recession anytime soon. We may have a slowdown in connection with the resurgence of the COVID, but I think it's not going to be a full-fledged recession. And so we have a good economic outlook. We have high PE ratios for tech companies, but perhaps warranted, maybe a little higher than is warranted, but certainly not entirely unwarranted. So I don't think we have to flee the market. I don't think we have to eliminate the risk in our portfolios. But on the other hand, I do think that given the things I described, it's desirable to have a portfolio which, while invested, and I'm not saying people should divest, but while invested, I think it's desirable to have an overweighting of caution in our portfolios. So, you know, our mantra at Oaktree is move forward, but with caution at this time. It has been our mantra for a few years now. And I would continue to highly value caution in our portfolios. But fully invested in a cautious manner, I think is a good way to be right now.
At a time, Mr. Marks, when inflation, whenever it comes back, and interest rates, whenever they go higher, it will only go higher. So inflation is coming back and interest rates eventually will go higher. Do you think investing in the debt market is going to be difficult?
Look, there's a direct connection. If rates go up, prices go down. That's, you know, that's just fact of life. A bond with a 3% interest rate is very desirable when interest rates are 0, but not desirable when interest rates are 6. And it has to decline in price in order to provide an adequate return when rates go up. So this is the relationship. Rates up, price down, rates down, price up. And that's immutable. However, all assets decline in value when prices go up. You know, the value of an asset is the discounted present value of the future cash flows. And the discounted value goes down when the discount rate goes up. That's immutable also. So I think that it's something we have to worry about. I think I know the Fed is not worried about inflation. And if you look at the world, Japan and Europe, for example, have been trying to get 2% inflation for the last decade, and they can't do it. So, and even in the US, you know, there's something called the Phillips curve, which has been thought to define inflation, that inflation goes up when the unemployment rate goes down because the slack goes out of the economy and workers get more negotiating power and so forth. And so we've had low unemployment, and well, I should say declining unemployment for the last 12 years since the global financial crisis. We've had the lowest unemployment rates in 50 years in 2018 and 19 and into 20, and we still haven't had inflation. So I don't think we can be doctrinaire about the fact that we'll have inflation, and so I think we have to have our investments. Again, there's nothing we can do about the possibility of inflation. We certainly can't be sure it's coming. We can't eliminate our portfolio holdings, but I think we should invest in a cautious manner. What does that mean with regard to inflation? It really means no long bonds. That's the most important single thing, because if you have a long bond and inflation and rates go up, it has a very difficult effect on a long bond. Short bonds are not that affected. So I think, I think again, invested but cautiously is the right thing.
Just a couple of last follow-up questions, Mr. Marks.
Sure.
In your book, you've specifically mentioned about India, and I've read that, reference to India. You have investments in India. I'm not getting into why and where, but in general, how would you view India as an investment destination?
Well, look, I think that India has great potential. It has enormous resources, especially human resources. It has good respect for education. The people that I meet in India are impressive and disciplined and intelligent. And I think that India has a bright future. It has to kind of get itself together and operate well. But we have a group in Singapore, which we're devoting significant resources. We're active in India, and I'm optimistic about it. I came back from my trip a few years ago, very impressed, and I look forward to my future with India.
What is your view on China, considering that China one policy is something which is part of the boardroom narratives now? China is no longer, the Chinese economy is no longer expanding the way it was. Is that a challenge that China may not be the big superpower or the big driver now?
Well, I think that China also has a great future. I think that they too have great resources. They are very organized. They have a benign autocratic government which makes decisions and implements them effectively and promptly. It is true that their growth rate is decelerating, but it is still very high relative to the rest of the world. They can produce 6+% GDP growth, and that is very much above average for the world. U.S. is at present less than half that, so now they have some difficult transitions. It's hard to transition from 12% growth to 6%. It's hard to transition from an economy that has been accelerated by very strong availability of financing for fixed investment, which maybe has produced excessive fixed investment, and they have to make financing less available and have less fixed investment take place and transition to a consumption economy. They have to transition from an export-oriented economy to a domestic consumption-oriented economy. So there are a lot of transitions that they have to make, but so far they seem to be making them well. And they did quite well in 2020 compared to much of the rest of the world, and seem to be coming out ahead of much of the world in 2021. Again, we're optimistic on China. Now, I always say that the U.S., for example, is a mature adult, and India and China are adolescents. And I've had adolescents at home, and the world with the adolescent is rather tempestuous. and up and down and volatile, but the outlook is very positive for the adolescent. And I think that's true of India, and I think it's true of China, and we're very happy with our activities there, which are substantial.
Just one last question, and since your book always refers to cycle, given that right now interest rates are low, do you think the importance of cycle gets defeated? Because there is no inflation, rates are low. It is quite contrary to the previous cycles we've seen where inflation comes back and rates and inflation comes back and rates go higher.
Yes, well, I'm not convinced that inflation is not coming back, and I'm not convinced that rates aren't going higher. And the people who are sure that you can inject massive amounts of liquidity into an economy and sure that you can run enormous deficits and increase your debts and not have any inflation, I think their confidence is misplaced. I'm not a forecaster. My saying is always, we never know where we're going. We should know where we are. That should inform our actions. I'm not an economist. I don't say I know what's going to happen with inflation. I just think that it's hard to believe that we can have the benefits of injecting trillions of dollars into the economy without and running up our debts in the trillions. And last year we added about 25% to our debts and 6 trillion to our debts. And I think it's overly optimistic to be confident that we can do those things without any negative consequences. That's all I would say.
Howard Marks never predicts and he never gives a price target, but I'm tempted to ask you one last follow-up question, I promise, which is that you always said that humans can always do things in an excess and cycles can extend themselves. Do you think right now the cycle is extending itself in Bitcoin and cryptocurrency?
I think that the cycle, I think that behavior has been aggressive. And I think that it's been aggressive for 2 reasons. Number one, because aggressive behavior has been rewarded in the last 10 months. And number 2, because interest rates are so low, we're in a low return world. And if you say we're in a low return world, but I'm not content with a low return, then you have to be active in an aggressive way in order to get high returns in a low return world. It's risky. And you shouldn't do it with the Pollyanna attitude, with great confidence. It's not my style. But you have to. Most people feel they have to do it because they can't settle with returns of 0 on cash, 1 on treasuries, 2 on high grade bonds. Most American investors need 7 or 6 or 7.5. And in order to do that in a low return world, you have to behave in a risky fashion. On the other hand, I'm not worried about the economy because I think we are at the beginning of a positive cycle. And I would not encourage, again, people to not invest. But I think that in a world where many people are behaving in an aggressive fashion in order to make a high return in a low return world, I would not behave in an aggressive fashion. Buffett says, the less prudence with which others are conducting their affairs, the greater prudence with which we must conduct our own affairs. And I think that's a good motto for today.
Mr. Marks, really appreciate your time. Thank you for joining us. You ended the interaction with the Buffett quote, but I'll interact with a quote from Howard Marks, which is that never forget the importance of risk. This is something which is always underrated by investors. Thank you very much, sir. Stay safe.
I look forward to my next visit to India. Thank you, Nicole.
Thank you.
Okay.
Thank you.
Bye.